But as we move into the fall of this year, I mean, we'll be not only talking about an end of this quantitative tightening and an end of rate hikes, we'll be talking about rate cuts.
SDBullion.com is a high-volume physical gold, silver, and precious metal dealer. Founded in March 2012 with the goal of providing the lowest cost bullion available, SD Bullion has become one of the largest US-based precious metal dealers and is regularly recognized by Inc. magazine as one of America's fastest growing companies. SD Bullion continues to gain industry market share by being one of the premier low-cost options for physical precious metal bullion buyers and sellers. At SDBullion.com, you can order your guaranteed physical precious metal bullion products online, 24 hours a day, 7 days a week. Discreet, low-cost delivery is both fast and always fully insured. We are committed to being your trusted source for low-cost, highest quality, investment-grade bullion products. Visit SDBullion.com for more information.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and with us today is Craig Hemke, aka Turd Ferguson, from TFMetalsReport. Craig, thank you so much for joining us today.
Hey Elijah, it's great to see you. It's always fun to visit, and I think we're going to have a pretty exciting year, so this ought to be a fun conversation.
Definitely. Now, we just saw President Trump officially end the government shutdown. It was the longest government shutdown in history. It seems like there's still a lot of gridlock, though. We have just until, the middle of February, and we might go back into a government shutdown if the Republicans and Democrats and Trump can't come together on a deal with respect to border security. So what is your perspective on all this and how it will impact, how this political turmoil, this gridlock will impact things going forward?
Well, to the shutdown specifically, I think it was terrific that they at least passed this 3-week respite back on Friday, because it allowed all the government employees that had been impacted by not getting paychecks to actually get a paycheck, because they were all going to be missing a second paycheck last Friday. So I would assume, it's all been processed now to not only give them Friday's paycheck, but then the previous one too. So all those folks are back, to not, doing garage sales and hitting the food pantry and that kind of thing. And that's probably an interesting point that needs to be mentioned, Elijah, is the fact that, we've seen studies over the last few years and polls, about how 65% of American adults don't even have $1,000 in savings, or if suddenly their car broke down and they needed a new transmission, they'd have to take out a loan because they don't even have, $400 in emergency funds. Then you get stuff like what we just saw and all the news reports of these federal employees. They're just living paycheck to paycheck, not presuming that they have money for retirement, and money for educating their kids or taking care of their parents. They're just simply, living paycheck to pay rent and eat. And it's not just, these aren't just government employees that are in that situation. I mean, this is, a great percentage, even a majority of American adults. And so, if anything, one of the lasting impacts of that shutdown should be to shine the light of how woefully unprepared people are for the next financial downturn. Besides that, though, the government now is reopened, if you will, for a couple weeks. Maybe we'll get a commitment of traders report this Friday, Elijah. It's been over a month. But I guess at the end of the day, what this is really all about is just dysfunction within the U.S. Government. And this is very important going forward in an economic sense, because just think back to where we were during the latter stage of the Obama administration and exiting that. I mean, it was really kind of an economic malaise. The Fed the other central banks had created all these trillions of cash, and yet they're really, it was kind of fits and starts of growth. The only thing that seemed to really perk things up was really the election of Trump, because businesses and consumers started thinking, maybe we're going to get some tax cuts, and there was going to be this money coming back from overseas and all these things. I mean, you can look back now in 2017 and into the first half of last year, and I guess at least based on the government printed data, you can say, okay, there was a connection there. Well, now here we are. And you and I started talking about this last year. Political risk is going to be a really big deal going forward. Not only the impeachment maybe and the investigations of Trump, but just this gridlock as shown by the government shutdown. There's nothing's going to happen going forward. All talks of infrastructure plans and all that kind of stuff. The Democrats will have none of it because they're not going to give their political opponent anything to run on in 2020. And so all of that consumer confidence and all that business confidence that was so important in at least coming up with some growth is going to fade. Not even counting, the drawdown in GDP this quarter because of these shutdowns and the shutdown that's probably going to come back after Valentine's Day. Just a dwindling confidence that things are getting better, not worse. That is going to accelerate the economy slowing this year. And then that's all going to be a big part of why the Fed will be changing course as well. And that is probably the next topic for us.
Definitely, yeah. And looking at the rest we're 1 month into the new year. I mean, what is your perspective on how the Fed will react to this? Because right now we're seeing, it seems like they're kind of hawkish, kind of dovish. They're saying maybe just a couple more rate hikes this year. Do you see them resorting maybe back to quantitative easing if the economy gets worse?
Yeah, eventually. And we've been talking about, you and I have been speaking about this for really the last year. At the beginning of every year, I like to write, a whole summary of where I think things are headed. And I was probably about 6 months early last year and about $100 short, as I thought most of what we're currently seeing would have made itself, apparent in the back half of last year. And we're really only beginning to see it now with this declining consumer confidence and the slowing economy and how that's impacting the perception of what the Fed is going to do next. There was a lot of talk back in December that the only reason gold was rallying was because the stock market was going down. Sure, okay, that helped a little bit. But gold was rallying because the bond market was rallying like mad and interest rates were falling dramatically as this realization starts to take hold, and it's still taking hold, that the Fed isn't going to hike 4 times this year as they were claiming as recently as November. I mean, I think most folks would at this point be surprised if they even hike in March. And with the economy slowing, with, again, this gridlock and everything else that's going on in the world, and obviously we found that the stock market can't handle any higher rates than 3% on the 10-year, I think it's pretty clear that as we move into the fall, and again, I may be early by a couple of months, who knows? But as we move into the fall of this year, I mean, we'll be not only talking about an end of this quantitative tightening and an end of rate hikes, we'll be talking about rate cuts. Gold and silver, too, are beginning to anticipate that. We saw that just last Friday when gold was just kind of trudging along. It'd been kind of a dull week around 1280. And then this report comes out that the Fed is this week going to be discussing a pare back of their quantitative tightening, as they call it. And that's what drove gold, silver, everything else up, 1, 2, almost 3% last Friday. And again, it's this realization that this change is coming. And again, that's ultimately the theme this year for me and my site is how 2019 is in principle going to look a lot like 2010. No, it's not. It's not it's not a mirror image, but the old adage that history doesn't repeat, but it rhymes. There's going to be a lot of rhyming this year into next in terms of the dollar, the economy, Fed policy, and the precious metals. And it's going to rhyme really closely to 2010 and 11.
And if we look back at what happened with the stock market and also precious metals during that time, I mean, we saw, and that was also, when there was the U.S. debt downgrade. So we saw silver, if we, go back, it was like, it jumped from $21 to almost $50 pretty quickly, actually. I mean, considerably. It was really fast. And then we saw gold go up to above 1900 in intraday trading. So what is your perspective like on what precious metals will do during this time, and maybe the stock market also, because we saw the stock market go from 12,000 to about 10,000. for the Dow.
Speaking with the stock market first, most folks have probably seen charts now that overlay global central bank balance sheets, how much assets they have and how much dollars they've created with global stock indices. And you can see them moving. I mean, they're pretty closely correlated. So you can draw a conclusion that the stock market will only stay afloat as long as central banks are creating more liquidity. But now getting back to the 2010 versus 2019 analogy, in the summer of 2010, okay, we're now a year and a half post the financial crisis and the banking collapse and all that kind of stuff. By the summer of 2010, it was all about green shoots. People listening to you and I may recall, you couldn't turn on CNBC without somebody talking about green shoots. And, the economy was allegedly recovering and all this stuff. And, for printed GDP, the second quarter of 2010 was 3%. And everybody's like, hey, okay, the worst is behind us. The Fed had run their first quantitative easing program. It was supposed to be a one-off. They weren't monetizing the debt, though that is exactly what they were doing. When the Fed buys treasuries, how is that not monetizing the debt? But anyway, that was a one-off. It was done. Silver for the first half of 2010 ranged between 16 and 18. And gold began the year 2010 about 1050. Okay, so, prices, sadly, in a way, kind of similar to where we are. But by the middle part of 2010, it was clear that, the green shoots were wilting. Third quarter GDP fell down to 2%. And it was in the fall of 2010 that we started to hear rumblings about QE2. And in November of 2010, QE2 was announced. And that was, your next, whatever it was, $700 billion of additional quantitative easing. Wait a second, I thought we were done with that. And once that was announced, everybody really began to question if the Fed really did have a plan. Confidence of the dollar began to decline, coupled with troubles in Washington, D.C., as you mentioned, debt ceiling debates, political paralysis. By the time we got to August of 2011, S&P downgraded U.S. debt for the first time ever to AA plus from AAA. Gold and the Swiss franc were considered the only two remaining safe havens. All these things kind of came together. And it was all spurred on by, a turn in the economy, reducing confidence, making people question where the Fed really had a plan and whether they were in control. And I think you can see where, as the economy slows, all this political stuff is going on, and everything else that's happening in the world, as we move through this year, it's going to be a similar situation. Like I said, not necessarily repeating, but rhyming. And that's what you're seeing. That's why gold is already up from $1,200 to $1,300, is because people are anticipating that change. Now, whether gold goes, in 2010, gold was up 30%. It began the year at 1040 or 50 and finished the year up near 1,400, on its way to 1,900 in early September of 2011. And gold silver after going sideways for the first half of 2010 is that, it was in that second half and then into April of 2011 that it went from 18 to 48. Now, no one's going to sit here and say, so that's going to happen again. But the situation, the underlying fundamentals, everything else that created the conditions for that type of demand for metals exposure and physical metal too, those conditions are coming back. And that's why I'm pretty confident that we've got this pretty good handle on where things are going this year. And now's a really good time for people, if they haven't been, going to SD bullion and averaging down. If the last time you bought silver was in 2012 at $30 an ounce, and your average cost is 35. Well, now's the time to buy some more at 15, so you can start bringing your average cost down. And then further, I would add, I think we're getting pretty close to. Let me put it this way: who's going to believe the next time this all turns and heads down that, the Fed expected this and everything's going to be fine? I don't think they have that card to play anymore. And so I would also encourage, as prices recover, and you've been sitting on physical silver for the last 5 or 6 years, don't just go running down to the we buy gold people and dump it at 25. Because one, you're converting it back to dollars. What good is that? Every country in the world that owns dollars is getting out of dollars? Why do you want to convert your metal back into dollars? But second, I'd be very surprised if the Fed is able to regain control and regain everybody's confidence and thus see the metals roll back over once all this stuff plays out over the next year or two.
No, with respect to, we're seeing this, repeat of 2010, 11, or rhyming, you're saying. With respect to precious metals, I mean, do you see silver, like, I know, back in 2010, it was less than a year between when it was $20 to almost $50. Yeah. So
right.
Is it possible that we could see that kind of run up again?
Elijah, as soon as I say it's possible, every troll in the world is going to say, oh, this guy's just a pumper. Okay. But of course it's possible because, I mean, the market hasn't changed. I mean, it's still, the banks that make the markets and they create the contracts. And as long as there is more demand, not only for physical silver, but more demand for all this different types of silver derivative exposure and more demand than there is willing supply, then prices are going to go up. Could it happen again? Sure. And all the stuff that we talked about several years ago is still in play. The fact that, there's multiple levels of derivatives for the precious metals upon actual physical supply. It's a fractional reserve system, just like your local bank. You don't deposit $1,000 in the local bank and then they just keep it in storage for you. They loan it out, and leverage it up and collect fees and everything. Well, that's what the bullion banks do with precious metal. It's a fractional reserve system. They loan it out, they collect fees, all that kind of stuff. And so this whole pricing scheme is still based upon a limited amount of physical. And, if we ever get a real collapse in the global economy and people demand, run on the bank, in kind of It's a Wonderful Life type fashion, then things could really get out of hand. That's, I'm not going to say that's going to happen tomorrow, but the system is still structured that way. So the conditions, like I said, that created 2010 and 2011 are coming back. Whether it will be as crazy as it was then, whether it can get almost out of control as it did in April 2011 for the banks and silver, it remains to be seen. But anybody that's buying physical silver now at $15.80 or whatever it is, I just don't see a lot of downside from here.
Now, moving forward here, just looking at the 10-year Treasury yield, we saw a little while back quite a move up in the rates, but now it seems like ever since really the beginning of November, we've seen a big precipitous decline. It's been gone from about almost 3.25% down to below 2.75%. Now it's right about there. So where do you see the 10-year Treasury yield heading from here?
We mentioned that earlier. That's a big reason why gold was rallying coming out of November and through December, because falling interest rates really good for gold, right? Because gold doesn't pay a dividend. So we've seen that. That's always been a positive factor. And the algos are programmed to follow that, and if they see bond yields falling to buy gold, that kind of thing. But this is, I think, more than anything, a signal showing you what Fed policy is going to be this year. Because not only the 10-year note, but the 2-year note were both rising dramatically all through last year, just as Fed funds were going up 25 basis points every quarter. But beginning in November, both the 2-year note and the 10-year note began to roll over in yield as there was a whole bunch of bond buying. The uncertainty of what was going on in the stock market was one thing, but that's also kind of driven by what you're seeing in yields. If you go back a year ago, you remember it was right around the 1st of February in the Super Bowl last year that the stock market crashed hard and over the course of a week and then crashed again a couple weeks later. And it seemed as if the stock market couldn't handle 290 on the 10-year note because it got up there and then boom, the bottom fell out. Well, it began to digest that a little better as the year went along. But when we first got to 320 to 325 early in the fall last year, that was the first time the stock market started to show weakness. And I remember putting a couple things on Twitter and on my site that day in early November. I think it was maybe the 10th. Maybe it was earlier than that. But anyway, that the 10-year note got to 323 or 324, and the 2-year note got to 299. And I said, boy, the last time we got here, the stock market crashed, so you better watch out. And sure as heck, it sure did. And then that kind of feeds on itself. The uncertainty and the stock market crashing, people looking for a safe haven, so they start buying bonds. But now you can look and clearly see the 2-year note is telling you that the Fed they're not going to keep hiking because, they've already got Fed funds at 2.5. They hike again, they'd be at 275, and you'd be inverted from Fed funds to the 2-year. So, the market is telling you what's going to happen next. And this all fits into what we've spent, this time of this podcast discussing.
Definitely. And before we let you go, Craig, are there any last thoughts you'd like to add? And I guess, where can our viewers find you online?
Well, let's start there. TF Metals Report is a site. We've been at it now for 8.5 years, Elijah. And I was a relatively young man back then. You never know. I'm already in my 30s. I'm kidding. Anyway, the site is alive and strong, and it's populated with just a bunch of brilliant people. We all work together because we realize we're all in the same boat here, trying to navigate our way through this end of the great Keynesian experiment. So the site is TFMetalsReport.com. I encourage everybody to check it out. You'll just enjoy the camaraderie of a place where, the little bit of $12 a month keeps the trolls away, and you can just kind of interact freely, and everybody has a lot of fun. But if I were to advise anybody, I don't give financial advice and all that kind of stuff, but I think the greatest temptation that the precious metals collector and stacker is going to have as 2010 continues is to bail. Is to say, I've sat on this silver now for 7 years. It's finally back up to $24, and I'm going to blow it out. Keep in mind that if you sell your precious metal, in return, you're getting dollars. Okay. To me, that's not the best trade-off. But you jump off the ship, just happy to break even or whatever at this point. As the train continues along, you may end up chasing. So I just advise people to recognize the similarities of what's unfolding again, and to just be cautious and prudent and pay attention, and then, do what's right for you individually.
All right. Well, Craig Hemke, thank you so much for your insights today, and thank you so much for your time.
Elijah, it's always a pleasure. All the best to you. I hope we can talk again soon.